Shares in GameStop, again, shares in GameStop more than doubled in the final 90 minutes of Wednesday's trading session. So if you don't think this is madness, I'll just say it again. Shares in GameStop more than doubled in the final 90 minutes of Wednesday's trading session. I'm sure you were all investors out there who were getting involved in this stock. Just investors, yeah? As volatility returned to the favourite stock of the Reddit trading forum Wall Street Bets. They continued to skyrocket in extended trade. GameStop announced the departure of the CFO, Jim Bell, initially sending the stock lower. Business Insider reported Bell was pushed out by new board member and Chewy.com founder Ryan Cohen. Half an hour before the rally started, Cohen tweeted an image of a McDonald's ice cream cone with a frog emoji. Is this real? Is it April Fool's Day or something? I came into this business to talk about investment and people's wealth over a longer term period, about economy, about politics, which I have studied extensively as well. I didn't come in thinking that it was normal behaviour for a stock to double in extended trade and then someone to tweet, I'll finish the read because Karen's peaked by this one as well, an image of McDonald's ice cream cone with a frog emoji, leaving investors dissecting his message. Wow. Yeah, that's what we need to dissect. A frog emoji and an ice cream cone to work out whether we buy or sell a stock.
It's
that's
just another colourful way of describing some excess in the market. I mean, if you think about what you've covered in your lifetime,
what does that mean?
You've covered other excess too. You've covered the dot-com bubble. You've covered the XM markets before the crash around the financial crisis. This is part of another journey around excess.
So you agree that we're in a bubble?
I think we can all see bubbles in the market, whether we've got one overall bubble that's going to
Jay Powell can't.
The market index.
Do you know, I think Jay Powell gets it. Do you know what? I think I remember an interview with Jose Manuel Barroso a few years ago when he was the European Commission president. I don't know if Jeff can come in or we're allowed to do this. But I remember that interview. And I remember saying, but you know that the EU's got this huge problem here, but you keep saying everything's fantastic. There is no existential crisis. Do you know what he said to me off camera? And I don't think I'm giving away anything indiscreet. He said, what do you expect me to do? Of course, it's my job. I'm the European Commission president. Of course I see problems, but what do you expect me to say? My job is to build confidence in this institution. And do you know, I really respected him for his candid nature there on that one as well. And I think it's the same with the central banks. They're so terrified about the pandemic, rightly so. They're so terrified about the economic consequences that they can't see the debt bubble that's building up, that they can't see the bubble that's building up in stock, because they basically see it as a problem which is secondary or tertiary further down the line.
I think that can be very black and white when you say central banks are doing the wrong thing and they're creating inflation because you've got asset bubbles. I didn't say they're doing the wrong thing.
Here. What I said is they're concentrating on the clear and present danger, but they are creating other problems further down the line. It's not black and white.
So back at you then. What would you do if you were a central bank? Would you stop all the stimulus at this point?
No, but I would probably stop the experiment in negative interest rates because I don't think it's creating inflation, which they were supposed to do in areas such as, and it's destroyed destroyed a load of savers in Germany and their income, and it's destroyed the pensions industry going forward potentially because there won't be an income for the aging demographic across the board. So I would probably end the experiment in negative rates.
Well, what about for the Fed, who have not gone negative? What should they do?
Well, I think, aren't we getting a $1.9 trillion stimulus in the United States? Didn't we just have, hang on a second, you went there. Didn't we just have new home sales surging at the start of the year, 923,000 pace, sending lumber through the roof, copper through the roof as well? If that isn't an inflationary and strong stimulus coming from the economy, then what is?
But that's not the central bank. That money is coming through Congress. So what would you do if you're a Jay Powell?
It's the economy. It's the economy. People aren't buying.
You raise interest rates because you've got that stimulus coming through.
I didn't say that. I said that we have secondary and tertiary problems further down the line, which could be bigger than the problems we've got now, potentially.
Well, unfortunately, the problem is I don't think you can fix all parts of the economy. It's an issue where you
fix
stimulate.
One part, but you create a greater problem later on.
That is the unintended consequence, and it is a fine balance between allowing the stimulus to go through the system so you don't have economic scarring, you get the economy back on its feet, then slamming off some of that stimulus so you don't spook investors, but you stop asset bubbles. It's an incredibly difficult job.
Yeah, and they're creating more problems by increasing the stock of debt in the world to the levels it's at now, levels we've never seen historically.
But what's the answer? You don't stimulate, you don't put economies back on their feet, you don't take what is considered necessary action.
Is the answer creating hundreds of thousands of zombie companies that really couldn't finance themselves in the real world? Is that the answer? Because we still have loads of zombie companies left in Europe from the last crisis.
Well, I think the United States is a slightly different market where you do get the consolidation that takes place if you have somewhat of a zombie company.
Elon Musk has once again shown his clout on Twitter, triggering a 25% rally. 25% rally, one day, boom, like that, in cryptocurrency Dogecoin. Wasn't this one set up as a joke, Dogecoin? Anyway, The Tesla founder and CEO tweeted an image of the Dogecoin mascot dog landing on the moon. All right, I can't read this stuff anymore. To the moon has become a popular catchphrase on Reddit, implying that the price of an asset is going to see a huge increase. Here's someone you should listen to. Berkshire Hathaway's vice chairman, Charlie Munger, has lashed out at cryptocurrencies, overvalued stocks, SPACs and Robinhood. The longtime business partner of Warren Buffett said he doesn't know what's worse, Bitcoin hitting $50,000 or Tesla potentially breaking above $1 trillion in market capitalization. Munger said the trading platforms like Robinhood are luring in novice investors. He also chimed in on the boom of blank check acquisition companies, saying the world would be better off without SPACs.
Meantime, Fed Chair Jerome Powell has warned that it may take 3 years for inflation to exceed 2% as he continued to deliver a dovish message to lawmakers on Capitol Hill. Thomas Kosberg joins us, a senior US economist at Pictet Wealth Management. Thomas, you can hear us having a robust argument around the studio set about inflation bubbles, how the market is positioned at this point in the face of further stimulus. And as we heard from Jay Powell, that stimulus may go on for many years to come. Should we be concerned? Do you think inflation is just around the corner? And where does that leave market bubbles as well?
Right. The bottom line is that I think it's more likely to have asset price inflation than consumer price inflation, even though we might have a short-lived consumer price inflation in the spring. But I do think that despite the magnitude of the fiscal package, $1.9 trillion, I think that we're the inflation burst that we might see in the spring will be short-lived. Why is that? Because I think there's still some consumer anxiety. I also do not think that commodity prices will feed into core prices. And with regards to the Fed, actually, what you see is that when money goes into financial assets, it doesn't go into the real economy necessarily. So I'm actually quite serene about the inflation risk. However, two things to mention. One is that if there were a further infrastructure package, I think then we could start looking at a different equation. And point number two is that we still have to be worried about the confidence and the trust in the financial system and in economic policy making, because there's a buildup of debt. Confidence so far is actually quite strong, even though you see at the edge of the system some gradual erosion in confidence, but confidence is still there. But things can turn on a dime there, and we need trust in the financial system, and we have to be careful with economic policy making, not going to extreme.
Thomas, what we have seen in the last couple of weeks as market rates have spiked, it has taken some of the excess out of particular stocks and parts of the market where there's been rapid momentum in recent months. I want to ask you about the outlook then from here, because it feels as though we could be in for a couple of bumpy quarters on this bounce back recovery story, a little bit like what we saw last year when we saw a plunge in some of the demand numbers based on the services economy being largely shut. It doesn't feel like normal numbers are going to come through. We're going to get a spike potentially as economies open up, and then a bit more normalization, maybe more spikes down the road. How do market rates weather that storm that could be coming?
Well, regarding long-term rates, I think what's going on right now is that there is, the bond market is testing the Fed. Jerome Powell 2 days ago was quite serene about long-term rates. Yesterday, he showed a bit more cautiousness by mentioning, those 3 years, insisting on 3 years before at least 3 years before the first rate hike. So he starts to lean against the rise in long-term yields, but he may have to do a bit more. The bond market may again test the Fed, in my view. Now, I do not think the Fed's tolerance to the rise in long-term yields is that elevated. The U.S. economy has a lot of debt. It's very sensitive to long-term rates. I think the Fed will start to lean against the rise in long-term yields more than it has in the past few days. Also, we need the housing market. So if you see a strong rise in long-term rates, you could see a bumpy road ahead for the housing market. So I think that's also another consideration. And to come back to your point about the bumpiness of the recovery, yeah, I think it will be bumpy. There'll be stop and go in the reopening, especially until we get full vaccination, which is still not expected before the summer. And also, bumpiness also coming from financial market movements, including long-term yields.
Thomas, what do you think the Fed's tolerance is for falling asset prices? I ask the question because we lived through a Greenspan era where the Fed very clearly focused on keeping the market pumped up. We've had a Trump administration that's been very focused on keeping the market pumped up. What do you think Jay Powell is going to do if we begin to see markets top out and roll over as they basically anticipate no further QE?
Right. And, I think the Fed's guiding principle is first, do no harm. They are worried about a recession. They are worried about taper tantrum. They're worried about what happened in 2008. I think they absolutely want no issue out there. And that means further and further accommodation. And if there's a problem, I think they'll do more QE, including if there's too much of a rise in long-term yields, and that starts to destabilize equity markets. I think the Fed could well intervene and find, an excuse, maybe in the labor market, maybe in inflation, maybe somewhere else, to do more accommodation. The Fed, we're trapped in high accommodation, and that's likely to continue for some time.
I think you've nailed it, Thomas. Thank you so much for that. And it feeds back into the conversation we've been having on the program over recent days. Thomas Kosberg, the senior US economist at Pictet Wealth Management. Steve, there you have it. The Fed is focused on keeping asset prices higher.